A very good day to one and all. Today I'll be conducting a very absolutely essential primer, all right, to real estate investment trust. My name is Christopher Ng Wai Ching and I'm the ERM trainer under Dr. Wealth. Okay, before I begin, I would have to share a disclaimer. The purpose of this workshop is to provide educational materials. So when I actually talk about an investment security, they do not constitute a buy or sell recommendation. And myself or Dr. Wealth will not be liable for the information or losses caused directly or indirectly by the information contained in these notes. My goal for today is to ensure that beginners get a primer on Singapore REITs, okay, so that you will understand generally what you can expect when you invest in real estate investment trusts. And my agenda for today is I will be describing what Singapore real estate investment trusts are, how they work, what kind of role do they play in your portfolio, and I'll be talking about an unusual and interesting property of a successful REIT portfolio. And then we will deep dive into one particular real estate investment trust. So let's begin. So what are Singapore real estate investment trusts? All right. Currently, there are about 35 of these REITs in the SGX. Okay, they don't include stapled securities like the Hospitality Trust. And one very famous example of a REIT is the Capital Land Integrated Commercial Trust that actually owns all the iconic retail and offices in Singapore. That includes Raffles City, Plaza Singapura, Funan Centre. Right, their offices include the famous Capital Tower as well as Asia Square Tower 2. Right, and how do REITs actually work? All right, imagine investors gathering together before IPO to put your capital together, and banks then lending money to a central pool. And with this combined amount of capital, the real estate manager then proceeds to buy a portfolio of real estate assets. All right, it could be offices, it could be industrial buildings, and what happens is that it turns you into a landlord. Right, you are able to collect dividends from the company rentals, and sometimes when a building actually gains in value, they could actually sell it away and allow the investor to realize these gains. All right. Now, the beauty about real estate investment trusts for retail investors in Singapore is that rents are not taxed at the corporate level. If 90% of these rentals are returned to shareholders in the form of dividends, so that's the most important thing, right? It is not taxed at the corporate level. And when the dividends arrive in your bank account, they are also not taxed at the personal level as well. So it's a highly tax advantage kind of instrument. You can get more information on real estate investment trust by going into the SGX website. You click on to securities, prices and screeners, followed by prices. And after that, you will click on to REITs, and there'll be basically a display of the REITs that are trading in the market right now. So what role do REITs play in your investment portfolio? And in Singapore, real estate investment trusts are a cornerstone of a dividend-paying portfolio. And as you can see from the section to the right, I basically listed real estate investment trusts based on the amount of dividends that are generated on a regular basis. So there is a decent number of real estate investment trusts that provide more than 5% yield every year. All right. So imagine that if you can combine these REITs together to a portfolio, you can possibly get a 6% dividend yield. And for every $1 million that you have in this portfolio, you're generating $60,000 a year, right? Which is enough to sustain a HDB hardlander lifestyle in Singapore. So it's a very, very powerful way for people to get regular and recurring income, right, in Singapore. Now, the other property is that REITs, generally speaking, are very stable and low volatility property, right? Provided, all right, and there is one disclaimer, provided there is no pandemic crash, right? So generally, REITs let you sleep very well at night, with one exception, and that exception happened on March 2020 when real estate investment trusts actually crashed more than the greater STI index. All right. But beyond that, once you've survived the pandemic, generally speaking, you can look forward to a very stable, low volatility kind of portfolio. Now, REITs can be a very good investment for beginners because they reward you for being patient. They pay 6% every year, 2 to 4 times a year. So you could be getting paid 1.5% of your portfolio every 3 months. All right, REITs are generally forgiving, and investors generally lose less when the index is doing badly, taking into account the disclaimer that on March 2020, that was not the case. All right, but otherwise, all right, it would have been very forgiving. All right, and generally speaking, REITs have outperformed the STI for the past 10 years. But this is not something that is persistent, because increasingly we are finding that the better real estate investment trusts are already part of the STI index. All right, I'm going to share an unusual property for Singapore REITs for the people who are more savvy as an investor. And what is very interesting about the current market for REITs is that bargain hunting has not been profitable for quite a while. So one thing that you will realize if you are a quant is that the more expensive REITs tend to outperform the rest of the markets. So what we are seeing now is that if you were to observe the real estate investment trust with a higher price to book ratio, they tend to outperform, and they outperform by quite a bit. All right. So that being said, my concern for the people who learn this is that deliberately buying overpriced securities can be a risky proposition. So this persistent strategy is questionable, right? So what happens if interest rates rise? We do not know whether this factor will remain persistent in the future, but this is something very interesting for retail investors to take note of. So let's do a deeper dive into a very classic high-end real estate investment trust, and I've chosen Keppel Data Center REIT as an example. It's got the highest price to book ratio. It's done very well recently. And this is a pure play data center REIT that yields 3.91% in 2022. Okay, now it has gone up by a lot. So you will see that the target price is about $2.86. And currently the brokerage houses have a whole rating on the company. And the reason is because it has grown a lot during the pandemic. And everybody is trying to ask the million-dollar question, right? Can it grow through acquisitions? And how many data center assets can it acquire over the next 3 to 6 months, right? I expect the Keppel DC REIT to do well when things look bad, but when the economy actually recovers from the pandemic, it might actually become a laggard and underperform the rest of the market, all right? So this is a very simple deep dive, all right, for the people that want to learn a little bit more about probably one of the most popular REITs in the Singapore market right now. In summary, REITs are a very forgiving instrument. They pay an investor for being patient, and barring a special event like a March 2020 pandemic crash, it has a very low downside risk. Right? If you know how to pick outperforming REITs moving forward, okay, they present a challenge to even the best investors, because the best REITs are now growth instruments, and what you're trying to do is that you're trying to read the movement of their managers, and you want to see whether there are any opportunities for acquisitions in the future. All right. Nevertheless, if you're a beginner and you're aiming for 6% dividend yield with some amount of inflation protection, REITs are a good instrument for your portfolio. That's all there is to the beginner's introduction to REITs. Thank you very much.